do that. There we go. Great. I'm not going to repeat everything I just said, but that's all right. All right, so let's kick off. Kind of perfect timing recording right now. So, and I'll share my screen here in a second. I'll pull up. I use Thinkorswim to trade. I'll pull up a live screen here shortly, but I do want to cover some of the just basic foundational knowledge within moving averages before I start sharing screen. So, again, for beginners, really maybe even experts, understanding what a moving average is. So really what it is it's an average of individual price periods over time, right? So when you think about that, when you think about like a 200 moving average, it's simply the price closes every day of 200 periods. And the reason I say close is because you can actually change those settings within your trading platform. So if you're within Thinkorswim, if you chose to see a moving average over price opens, you could see that as well. There's different average formulas you can throw in there and tweak those numbers, but generally the standard is around price closes. And I say that too, because when you think about trading, you really want to trade within the crowd, meaning, when you're trading, for example, when you're trading a breakout, what you're trading is an influx of volume coming in at once on, a new high breakout. You're having volume surge in, right? So everybody's looking at the same thing. They want to get in at the same time. It's almost similar to moving averages. You want to be looking at what everybody else is looking at. So you don't really want to do a lot of tweaks. So you really want to make sure you're kind of following the crowd with moving averages and making sure you're looking at what everybody else is, because then you're really going to see if you were right or when something moves in your favor. So but you can change this if you wish, and happy to expand upon that too if you guys need to. Different types, simple moving average, the SMA. I know people are familiar with that one, or generally that's the one that people stick with first. The EMA, which is the exponential moving average. There's also smooth and weighted. I don't use those often. And I typically won't go into them too much, but simple and exponential are really the two most common, the SMA and the EMA. And the difference really between them is it's about sensitivity. So the SMA is really just a basic average of price closes or open or whatever you deem that metric to be over time. The EMA, the exponential, weights it to more of the current data. So next question I always get is, how do you choose which one to use? Well, what I have read, and really I've seen it work. I'm a swing trader, or a more of a medium long-term trader. So I have read that medium and long-term traders benefit SMAs more, and day traders or short-term traders EMAs. And I would say that's actually probably pretty true, because I stick with SMA, and it seems to work out pretty well for me. And I, to be honest, I actually even use it within day trading too. It just has something that I've learned to use, and I just have preferred it over EMA. But everybody's different, and there's no right or wrong answer within that. The one thing I also love about SMAs is that it helps you, at least I believe, it helps you control your emotions, because you're getting less sensitive price changes. Again, EMA is really going to bring that in towards the end. So you're not getting those quick knee-jerk reactions that you're getting and shaking you out. Again, if you're in something, you're swinging it, and you're looking within smaller time frames, like a 5 minute, and you see something jolt down quickly, it's going to add a little stress, and it might jolt you or trigger you to sell that position. SMAs, you might not get that as much. So if you think you're an emotional trader, I would challenge you to really look at maybe SMAs versus like EMAs, for example. So, and then the last one here before I start sharing my screen is really, which ones do you use? So some of the most common ones, the 9 length versus the 10, SMA or EMA. There's the 20 versus 21 SMA, EMA. I've heard that as well, or seen that as well. 50, 100, 200 SMAs. Those are pretty common. And those are pretty standard across the industry. And then sometimes you even see like 150, 300, 400, 500. I know those are a little extreme, but to be honest with you, I remember looking at those during COVID and seeing price meet those pretty drastically. So you could play around with some of those other ones, but generally what you're looking for is like a 9 or 10, a 20, 21, and then a 50, 100, or 200. And you don't have to put all of them on your charts, but those are just generally the standards. And so within the first bucket, we'll call it 9 and 10. People always ask, well, which one do you use? I personally use the 10. And I've also seen people use the 9. Again, it really just depends on what you've seen. When I've tested this through, day trading or really even really swing trading or within that daily view, I find that price is a little bit more compliant with the 10 and 21. Again, that's just how I viewed it. Now there are always going to be examples where that falls out, and I'm sure people that use 9 and 20 as well would probably say the same thing with theirs as well. So it just depends on whatever you test and learn and find works for you, but those are generally pretty common. And I will say what I have read from a swing trader or from a day trader, swing trader looking at daily timeframes is that the 10 SMA and the 21 SMA tend to be the favored time frame. So if you're looking to kind of start with something and move forward, that's generally what I have. So let me go, since that's a good segue into sharing my screen. So let's go ahead and start with that. And then we'll get into some of the trading strategies around each. And can anybody tell me if they see my screen? I don't know if anybody can. Let's see if I can go back here. Chat. Yes. Okay, cool. Thank you guys. All right. So there's really 4 types of uses, we'll call it. They're not all strategies, but we'll call it uses for what I'd say is like core and how I would recommend looking at moving averages. So the first one is really around projecting price targets. This one I actually kind of like a lot, and something I started using over time. So there's many different ways that you can look at projecting out price targets. If you're a new high breakout trader, meaning you're looking at something that is consolidating, breaks out to, here's a good example within SPY, but you're looking at something that's been consolidating sideways and it breaks out to the new level. You may have read things like, 10% move or 15, 20% move is the projection above that breakout or base, if you will. Another easy way to do it is if you're again not within a new high breakout strategy, because obviously the moving averages wouldn't be caught up. But if you're looking at like a drop, you might have a gap down or a heavy drop that maybe wasn't even a gap down, and you're looking for a bottoming effect or curl, call it, and you're looking like, where can this go? And I'll give you a good example here too. Is within, this was a last week trade, but you had heavy movement down here in Baxter. Again, drop down here. It's just continuing. Let me note here, the price dropped below the 10 SMA. So let me stop real quick because I just realized I didn't explain it to you guys. The purple line here is the 10 SMA. The orange line is the 21 SMA. The dark blue is the 50. This lighter blue, which is probably hard to distinguish between this, but the lighter blue that looks almost flat is your 200, and then your 100 above. So generally what you'll see is you'll see price moving along, chugging along next to this purple line, which is the 10 SMA, and then it's going to shoot down. Again, it'll be a gap down, or it may or may not even gap, and it's going to continue below it. And when you're within this space here, you're trying to project out when to get in, when in the bottom, when you might see a reverse. And there's a couple of different ways you can do that, right? You can look at RSI, which got heavily beaten down in this area. You can look at your MACD curl. But the other thing you can start to look at is where's price going to go to in relation to the MAs or your moving averages. And one thing that you'll see that I always notice is it's going to test the 10. And sometimes it'll test it, it'll reject and keep going lower, test it, reject and keep going lower. And really what makes, and this is a strategy that we'll talk about soon, but what makes this strategy really, really interesting is that you are trying to time, at least in this strategy, it's RSI plus MACD plus your moving averages. And you're really trying to time the crossover with a low RSI and when price is just about to cross over the 9MA as well. That's when you start to see really good support. So this is one example. I'll give you another example with, this is one I tracked and was trading this week, it's pins. Excuse some of the grayed out area. This is some mobile charting that's converted to my desktop. But again, same thing, you see it gap down. This gray area is your gap. So you got the gap down below the 10 SMA, chugs along, still staying below. Again, you got the same thing, RSI down here is in kind of this red zone. And you got your MACD starting to curl, get closer up. And really the price, again, right here, low RSI, MACD starting to curl up, and you start to see it all kind of comes together at once and makes that move higher. And really the strategy here, if you choose to do this, I look at this on the daily chart. You could also do this in multiple time frames. You could look at the 5-minute, which I do trade this during the 5-minute. Usually, honestly, usually it's around like 10, 11, or 12 is when I start to see that 5-minute setups look identical to this, where they gap down in the morning, they start to come up, and then usually around like 10, 30, 11 is when you're starting to find some of these that look like this. But really, you're looking for the cross up is when you enter, and then you're looking for the hit to the 21, which can be the rejection. So, you know, generally, if you're getting in right here and you're moving up, that's about a 30% option when you give or take, depending on what position you're in and when you enter. So I'll do those day trades multiple times a day, different positions. And again, I'm just getting in right when I get the confirmation it's crossed over, and I'm playing it right to the rejection. And you did see that a little bit, I think, with pins today, where, you know, it got up to the near the 21 and, you know, it couldn't quite cross it. So, yeah, so price targets or projections is one way to use it. And, you know, the other thing is we talked about kind of the, I guess, resistance point. There's also the support point of it too. So when you're looking at, and I call it distance from your moving averages, and I'm going to pull up a chart that everybody probably knows from today. So you've got two cases here. So this is an example where learn from it, but don't take this approach or chase it, we'll call it. So one thing I like to do is look at price as a relation to the 10 SMA. So again, if you look at this chart, you're seeing price generally stays around that purple line, you know, with some fluctuations here, but generally when it's popped up or popped down, it's either gone flat and returned or waited or paused and let that catch up. Again, you're seeing that through here. This is an example where, you know, if I see something like this and I see this way up here, I'm probably going to second guess maybe getting in up here, although I will say this candle looks really bullish. But, you know, this would be something where I'm probably asking myself, it's pretty far away from that average and what we've seen. Is this a good spot to take it entry? I'm not suggesting short it by any means, and I'm not suggesting absolutely don't get in it. It's just a gauge for you to question whether it's a good entry point or not. A good way to good stocks where I think this is more relevant would be like, I'll give you an example here, like Microsoft, right? Where you're seeing these price changes move up above and below slightly, but not anything drastic, right? Because news isn't driving it, as you saw in that previous stock. Again, the previous one, right? GameStop, AMC, all those are in that. You're not shorting into that type of, or at least you shouldn't be shorting in that type of momentum. So That's why I said I wouldn't necessarily take those types of stocks. I would take the ones that, or I would look at the ones that are, moving naturally in a way, but on no significant news. Because even Microsoft, right? You've seen these indicate earnings in major events, dividends as well. You see that those aren't even massive enough to really drive it away, and get you in trouble. Like down here was right around that dividend was a drop, but then it kind of went sideways and moved up. Same thing kind of in this landscape. You got earnings coming up here, but again, a drop below, but nothing really drastic. It's still kind of staying around there. Other thing I'll say is within Google too. Google is kind of the same thing, right? We've had some really good earnings on Google. Here's one where you've had the gap up, right? So like if you're looking straight at this day, that's a pretty big gap, and then it's been sideways where it meets, and then it kind of makes its choice about what it's going to do. Same thing here, it starts to go up and tailors over. So that's, again, I use this that not necessarily a strategy, but it's more of a mindset of the distance from the MA. Am I entering at a good time? Like if I'm buying within here in this candle, is this the best candle to be buying that? And again, this candle alone is pretty bearish, but generally, like, is this the best spot to be entering at, or should I wait for some type of consolidation or cool down? So that's another one. We'll call it the second one. The third one is really around famous crossovers, and there's not really much to show here, but I just want to touch on what I was talking about before is really about price interacting with the MAs. You can also have a situation where you trade MA crossovers. So let me see. This is one I used to trade quite heavily. Has had a lot of movement. So, Lockheed Martin. I'm trying to find the example here. Here's the example here. So there's really two famous ones, and there's more you can really get into if you're interested in this. But right around in here, so this is the 50, again, this dark blue line. This is the 50 moving average, and this is the 200. So one of like a famous type of SMA is what they call a golden cross, and that's when the 50 moving average crosses over the 200. And a lot of people find that bullish, and that's when they choose to enter. Now you can see, and this is why I don't generally trade them, is that if you would have entered with this crossover, you probably wouldn't have done much. Maybe if you got in at the bottom around here, and you might grab the high if you held, but most people aren't selling that short. They're holding for longer term. So that's one reason why I don't particularly like these, but there are a lot of people that do trade these, and they do find success with them, especially on a longer term basis. If you're trading, if you're managing your own IRA account, your retirement accounts, a lot of people do trade in this manner for sure. So the 50 moving average crossover of the 200, that is a bullish signal, the golden cross they call it. The other one is the cross down. It's the death cross. And again, I'm not going to go into charts for this one, but again, that's just the reverse. That would be when the 50 moving averages crosses below the 200. So in this case, you would have the 200 here with the 50 approaching. It looks likely that this is going to cross. Of course, we don't know what's going to happen with Lockheed Martin in the Middle East news. Of course, they could completely reverse and drive it up, but generally this looks like it's approaching the 200, and it's going to cross and make that death cross. So that would signal like a bearish or an exit, if you will, to long-term investors. But again, not something that I generally trade, but just be aware that these are pretty famous, and there are more. You can certainly look these up, and if you choose to look into that a little bit more, trade that way. So then the other one, really the last one, and I touched on this earlier, and I kind of want to go back to it. And I got perfect timing because I've got about 10 minutes. But it's the crossover, the MACD RSI 10 MA crossovers. This is the one I touched on a little bit with pins and I guess a couple other stocks. So let me zoom in here. So GoDaddy was one I used this week that I absolutely loved. This is one I traded. So again, same thing as we saw in pins. Gap down, doesn't have to be a gap down, could be just a simple weakness, shoot down without a gap, stays below the 10 MA. And then right around here, right, you see that perfect cross with the MACD below. RSI was already generally pretty low, below 40. That's when I like to insure or take these trades. And then again, not this day, I didn't take it, but it was this next morning. I saw it here, and then obviously it came down below, and that's when I took it, and it just kind of shot up. So this was a really quick trade, right? It was a 2-day trade. Approached near the 21 MA, and that's kind of when I got out. So I'm sorry, I'm pulling up something inside, but yeah, so that would be a strategy. And I would tell you too, when price moves up to this 21, a lot of times people will set their exit or their price target at that 21 MA price. You don't always have to do that. And I'll tell you, even with gap fills, I don't do that. Sometimes I'll set my price 20 cents, 40 cents, $1 below the fill, because the reason why is because everybody's looking at that price and everybody's looking to exit that price. And you don't really want to be the last one in line trying to get out when everybody's pushing price down, selling. So I will generally take a little bit less. And for me, it's not always about grabbing the whole trade. It's about grabbing a large chunk and moving on. So, so with that, there's two other things I just kind of want to reiterate. Is one, in this case, when moving averages, you do want to follow the crowd. You want to pick moving averages that align to what everybody else is seeing. So again, when you see price jump above here, you're getting those big candles, and you're going to know if you're right or wrong, and everything's set up properly, because you're going to see those big moves, or you're going to see a good hard rejection when it didn't work out. The other thing is that you can use moving averages on multiple time frames. I know we talked a lot about daily, maybe a little bit about the 5-minute, but really, if you like the 1 hour or the 15-minute, use them. They're effective. I've traded them before. I found the 5-minute and the daily to be the most effective, but again, everybody's got their own different trading styles and what works, and you can certainly tailor these to make a difference in your trade. So with that being said, I know I got a little bit of time left here. I'm gonna pull it back, stop screen sharing. Let me go through the chat here real quick. See if there's anything that people have questions on. And if not, then thank you for joining. The technical difficulties. Yeah, I know with the what was it, support? Is that the name? SPRT? Is that the name of the stock, support? Let me see. Yep, support. I knew that would be a touchy one. Right when I wrote it down, I knew it would kind of be touchy, and of course, like AMC or GameStop. So again, I just wanted to reiterate, guys, those are momentum stocks, and it's death taking, put positions against them unless you're you find those bearish signals, and usually they're blatant candles or pin bars or inverted hammers, if you will, that gives off the signals. Not always, but you can see it with volume too. But yeah, certainly not telling people to short those by any means. So I just saw the note here for Geo. The big difference between the I assume you mean EMA and SMA is really around sensitivity. The SMA is really just an average across your time period, whether it's 21, 9. The EMA is it's more weighted towards the most recent movements. So that's going to be a little bit more sensitive to recent price movements, which benefits day traders, to be honest with you. If you're fully a day trader, I would really look at the EMAs. So. Yep, I swing trade too. I would certainly look into SMAs. And if you're looking for which ones to use, it depends on how short or how long of a swing trader you are. If you're like within the week, we'll call it multiple days. That's what I tend to be. I like to hold for a few days. Although I do have long-term positions as well. But if you're more of a medium swing trader, we'll call it a few days within the week, I would really look at like a 10 SMA or a 9 SMA and then a 21. Perfect. There you go. Absolutely. Love it. All right, guys, looks like we have about 4 minutes left and it's counting down. So yep. I hear you. And a lot of people use them differently too. So if you're looking at other people's charts, you're gonna certainly question what they're using. Because I honestly, I've even thrown a like 10 SMA and like a 10 EMA, and obviously it's pretty close. And it's interesting. You should try it sometime if you haven't. But you can see the jolts, and I instantly learned that I love the SMA more because it's less emotional, I'll call it. I don't feel like I'm panicking to get out, which is what, I always try to control emotions in trading. So, but. Sector right now, that's an interesting question. I don't know if I can cover it in 3 minutes, but obviously everybody has eyes on tech. Tech's been pretty strong. I guess it depends on how you define environment. I think everybody's got a different opinion on that. I think regardless of opinion, no one can deny that we are in a strong bull market. We do see bounces or taps on the 50 MA if you're looking at the daily chart. So there's no denying that we're in a really strong bull market, and that just continues. What I'll say, and honestly, that's why tech has been so favored. And I know there's been fluctuations throughout the year where we've seen the Dow and there's like SPY come into play, or stocks within those, and then tech leg, and it's been flipped at times. So there's been fluctuations with that, which or divergences, if you will, that kind of cause question. But tech's been really strong. Continue to see new high breakouts with those. Google, we saw Microsoft. Apple's up there. I think Tesla's not really pushing new highs, but it's in a wedge right now. But you really see those guys leading the way. One thing I will say, and this is kind of the point I wanted to get to, is that if we get to a point where you start to see weakness in the market, which could come, there's the Jackson Hole meetings that are going on into the weekend, and the talks of tapering. Usually what you do find is utilities start to pop. So that would be a sector I would watch closely. We start to see utilities run. That means people are shifting into safe zones. Typically you see gold be that, but we haven't seen that at all, actually. And gold actually performs really well in August and September, and it just simply hasn't happened right now. So there's a lot of weird examples going on in the market, but utilities would be one I'd watch. Materials, industrials are another you could watch, although utilities is kind of the number one in that space. But when you start seeing materials and industrials run, I've read that's been indications of like an end of a bull run. So things like that. But I have to tell you, it's hard to go away from tech right now. I mean, again, we're in a strong bull market unless something cracks. It's hard to go away from that because it's where the growth has been. So I got about a minute left. I'll try and answer this. I love Lockheed Martin. Used to be this, I'd say even maybe before the massive COVID drop, that was basically what I traded all the time. I don't know that Jackson Hole was going to impact Lockheed Martin as much. Jackson Hole is going to impact everything if it impacts anything at all. What might impact Lockheed Martin is going to be the stuff going on in the Middle East. It may not run it up like you might see from like KTOS, because that's a little bit smaller price point. But you're probably going to see a little bit of strength in the short term, or a hold, if you will. But I'm not expecting much. I'm not sure that's enough to push it. So, and guys, if you have any more questions, you can ask me in in the Discord app of Titanflow, or obviously on my Twitter as well. We can certainly continue the conversation if you guys have more questions. So looks like I'm